Hi, everyone. Thank you for joining me. Let's just do a quick time check here. All right, it's 2 o'clock. Let's see, can everyone hear me? Maybe bring up your little control panel and send me a text and just let me know if you guys can hear me. Okay, excellent. Perfect. Okay, why don't we just get started? I see people are still joining. Okay. All right, so my name is Brad Renard. I'm with Monthly Cash Through Options. And the objective of this presentation is to talk about the IC1 strategy, the Iron Condor 1 strategy. And I retooled it a couple of years ago, and it's doing well. So I just wanted to start talking about it and give an update to all my existing customers that go way back. I've been working with people as far as 10, 11 years ago. I do see some names that look familiar, and I'm pretty excited about it. So, okay, so the agenda is, let's just review pretty quickly what a Iron Condor is, and then I'll start talking about the difference of what I've done with this new improved IC1 strategy, and then I'll tell you what I see with the markets today and my convictions with the SPX index, the S&P 500 index. That's the primary index that I trade. All right, just quickly, my background, I'm more on the high-tech side. I was in Silicon Valley for 20 years. I'm an engineer. My first job out of engineering school was in the spacecraft group at GE in New Jersey. Did that for 3 years, went back to business school, and then went out to Silicon Valley. So I was with Cadence Design Systems and many small companies, mostly on the marketing and sales side. And then I co-founded an internet company for a couple of years, and then I went back into EDA. So EDA is electronic design automation software. That's software that's used for chip design, and that was the primary space that I was in for a long time. All right, 1 second. I was in Japan for a couple of years, running one of the branch offices. My education is in physics, electrical engineering from Columbia, MBA from University of Chicago. Traded stocks from the time I was in college, moved into options trading in 1999, launched MCTO in 2004. Okay, so MCTO, we are growing. We have multiple strategies. What we're going to focus on today is primarily the IC1. I'm the chief publisher, Brad Renard, the speaker. It's an income-generating non-directional strategy. We sell far out of the money, 85% probability calls and puts on the SPX and the RUT, and these are all 2-week in duration trades. And that's one of the main changes that I made. It's a faster moving strategy now. I also use week 1, week 2, week 4, week 5 options. I avoid the week 3s, the monthlies, and that's another major change. So we moved to 2-week in duration and week 1s, and basically the weekly options. This strategy has a 12-year track record. I've actually been trading these Iron Condors and credit spreads for about 15 years now. And it's doing well. It's up almost 40% year to date, and August is also looking really good, and we'll see. It's not over until it's over, but I'm currently sitting on about a 15% gain for August. We have another strategy called DAC1, Directional Alpha Collection. Chief publisher is Pranav Singh. This is a shorter term, 3 to 15 days in duration, long, short, directional trades on stocks. So we allocate 3% of the cash to each trade, usually have 15 to 25 positions open at any one time. And actually his is up about 27% year to date, so he's doing pretty well. Time decay, that's another non-directional strategy like IC1. Amir Atabaki is the chief publisher. It's income generating, non-directional. He sells 85 to 90% probability spread, similar to what I do, but his are 30 to 60 days in duration on both the SPX and the RUT. and then he closes everything early. So he's looking to book the profit, about half the profit when he has the opportunity to buy back the spread. Okay, so those are 3 of the services that we have. And then we have 2 newsletters. We have the MCTO letter. I'm the chief publisher of that. And this is really the analysis that I've been doing weekly, every week for 12 years. It has technical sentiment, macroeconomic market analysis, and it can help investors and traders really better time just about their entries and their exits, really regardless of their strategy. And we deliver that every week, Monday, Sunday or Monday. And that's been in continuous publication since 2005. And then finally, Trade of the Day newsletter, TOTD. So that's Pranav Singh. He has the DAC1 service, which is the auto trade version of this. And this is more for the self-managed. This is a service for the self-managed subscribers. Comprises 3 selected trades from the DAC1 service, and he emails those out each week. And as a reminder, what the DAC1 service is, it's 3 to 15 days in duration, long, short directionals on stocks. Those are calls, puts at the money or slightly in the money on stocks. And they're set up to really take short-term gains, and then we're out pretty fast. Okay, the new improved IC1 strategy. This is an option selling strategy on the SPX and the RUT. In the last couple of years, I've been primarily focusing on the SPX. I'll probably start turning on the RUT again. What happened is that we used to have 7 different market makers we could go to on the RUT, and someone made a decision to only have 2. So I could see that liquidity dried up on the RUT, and it's not as good as it used to be. So I've been somewhat avoiding the RUT recently. So the indexes, SPX, they're naturally diversified with hundreds to thousands of stocks. The SPX has 500 stocks in it, and it eliminates company and industry-specific risk. These are 2-week in duration trades. I used to do 4-week in duration trades. I used to pile them all up in the week 3s or the monthlies, and now I spread them out and do many, many more trades each week. So it's much faster moving, much more nimble. And it was required. This market really changed in the last 5 years, especially with the Fed involved in quantitative easing and printing money, and European Union doing the same thing, Bank of Japan. It was just, this market got really tough to trade. So we use the week 1s, week 2s, week 4s, week 5s. We avoid the monthlies. We do not go through settlement on the monthlies anymore. It just started getting way too risky. So historically, this strategy generates reliable monthly returns. We take the other side of the trade, where the profit is smaller, but the probability of being right is pretty high, about 85%. I used to be at 90% trades. Now I'm down to 85% trades, and in 2-week in duration. And I like it. It brings in quite a bit of premium, and then if I have to, all of a sudden the market starts moving and I have to start adjusting, I usually have a nice chunk of premium to use. I'll have to give it all back. I won't keep that premium that month, but primary objective is keep the accounts flat, the cash in the accounts flat when that market starts moving. And that's the main thing that I focus on, and that's the hardest part, and that's why I'm excited about it. I'm very excited that I can keep these accounts, the cash balance is flat when I'm moving the market, when I'm moving my trades and keeping up with the market if it starts moving. So writing spreads is like being the house of the casino. We make a little on both bullish and bearish bets by the speculators. Some bullish speculators want to buy calls, so we open our storefront and we sell calls. They're 2-week in duration calls with a very high probability of them not making much money or no money. And then you have bearish speculators. They want to buy puts. We'll sell 2-week in duration puts. So we achieve results weekly. Several trades expire every Friday, and I like that. It just makes the strategy much more nimble, and I just have trades always expiring, coming up on Friday, or I get out of them early, and we get out of most of our trades early these days. I'll pay the dime, the 15 cents, the 5 cents, the 25 cents, and we just keep the money active, keep on rolling it into new trades. We are constantly tap dancing around the market by moving trades. So this is the main thing right here. This is not easy to do. I've been doing this now for 15 years. It seems like just in the last 13 I've had a major breakthrough where my confidence is much higher in holding the cash balances flat during adjustment periods. So it's a lot of, you'll see it towards the end, I'll just talk about a few trades and what we do, and we're just constantly moving trades up and down as this market moves because we want to stay 1 week ahead of the market, and that's what we're doing. So also when I show numbers, I show everything with round trip commissions. So all of our returns do include commissions of 70 cents a contract, $5 ticket charge per leg, which is very typical these days, and round trip. And I round trip probably 3/4 of my trades because I'm in and out and moving constantly. So we time trades to a robust blend of technical and fundamental analysis. I will review what I usually cover each week in my analysis. So this service has, again, a 12-year track record. I've been doing these for about 15 years. IC1 is offered as auto trade and self-managed, but I really don't recommend self-managed much anymore. It's just too much work. This is much harder than it was. I used to pile everything in the week 3s. My objective was to hold them through expiration and settlement, and that's just not working anymore. It worked for about 7 years, and then about 3 years ago I just decided I had to retool the strategy and make it faster moving. So now for the self-managed folks, it's a whole lot of work, but it's still offered as self-managed for the people who want to do it. This strategy can truly manage larger accounts, 50, 100, 200K accounts, and for auto trade, we will trade up to 200 accounts, $200,000 accounts. And the reason I say that is because, one, we can keep the losses small during the difficult months. That's about 3 to 4 months out of the year, and that's the hardest part. So if you can keep the losses tight, -1, -2, -3 for the month, that's perfectly fine, and that's what we do with this strategy. And also I spread the capital across many trades each month, layering different strike prices and expiration dates. So about every other day I'm doing something, I'm opening something, I'm moving something. I'm allocating 20% of the capital to each trade, but also it's spread across a lot of trades that are constantly expiring. So I feel like that it is diversified, and it has a lot of trades through the month that allows us to truly manage a larger account. I do see some service providers out there that'll advertise, 7, 10, 12% a month, but in reality is that they only open a few trades. So that could be for a self-managed person, but most of our customers have real money. They got a $100,000 account, $150,000 account, 200, and they want to generate income out of it and want to keep the losses very tight and not lose the money. Okay, track record for IC1 service. For 2017, we're sitting at 39.9%. And what I'm going to focus on are these months here, because this is the hard stuff right here. This is the Trump rally, January, February, and March. Once the market is done rallying, then that's when we get back to work and we make some money. And the returns are looking pretty nice so far for year to date for 2017. But this is the hard part. And this is the part that takes a lot of experience of trying to keep those losses tight when the market is moving. So Trump was elected in November, market started moving in December, and then really just started trending higher and higher and higher and would not stop going up for January, February, March, and I was able to keep those losses pretty tight, and that is not easy to do. By the way, this is all these numbers are on our website, monthlycashthroughoptions.com. You'll see all the detailed trades and all the summary numbers for all the years, so you can get that off the website. Okay, why allocate some cash to non-directionals? Well, especially now, this market has come a long way. The Trump bump just took this market straight up in anticipation of pro-growth, reducing regulation, cutting taxes. Also, earnings just started to grow at that time. We had 5 straight quarters of negative earnings growth, and right when Trump was elected, the earnings growth started switching back into growth mode again. So we had pro-growth initiatives that Trump was pushing, plus Republican in the White House, plus in both houses. A lot of optimism around pro-growth, being pushed through at pro-growth policies, plus earnings were starting to grow. So this was a really strong uptrend. So different strategies take turns throughout the year in making positive returns. Well, just buying an index or buying your favorite stocks did just fine right after Trump was elected all the way through the middle of this year. Now things are kind of expensive. This market is no longer cheap. Okay, broad markets will historically trend up or down 4 or 5 months out of the year. All right, well, we already got our uptrend. A lot of that money was already made in traditional buy low, sell high, just buying indexes or buying stocks. Now, this market's not done going up. We'll probably end up at 2,500, 2,550 by the end of the year. And we'll be at 2,650 by the end of Q1 of next year. And that's just basically based on numbers and earnings growth. But that upside is not that high anymore. It's like a 5% upside potential, and that's why money managers have already been moving a lot of money now over to Europe and other countries, because a lot of the gains have already been made, and we'll still have some gains, but we just don't have a lot of upside potential right now. Okay, broad market will historically trend up or down 4 to 5 months out of the year. We saw it after Trump was elected. Broad market will trade range bound historically 7 to 8 months out of the year. That's kind of the mode we're in right now. This market's going to move, but it's not going to move like it did in January, February, and March and April. Stocks trade sideways choppy historically during the summer months. We're in that right now. August and September, that's why this market sideways choppy. It's possibly going to take out some lower lows, but we're still healthy. We're still okay. Earnings are good. The economy is good. I'll show some of the data. Long stocks make money, of course, when the market trends upward. Well, we had that. Double whammy. Earnings started growing, Trump was elected, and that's what we had. When earnings are growing, when jobs are growing, or jobs growth is positive, when interest rates aren't climbing too fast, when the Fed is on our side, all of that are still positives. It's almost kind of like Goldilocks. It's pretty good. But the stocks really have come a long, long way. They really, and this is how human beings are. The stock market is driven by fear and greed, and when greed kicks in, everyone kind of piles in, and then they push things up too high, and they overshoot. So we're kind of in that mode now where we're digesting all of these gains. All right, non-directional strategies historically do well 7 to 8 months out of the year. So when the market is not trending, and we're more in that historical 7, 8 months out of the year where the market's more sideways and choppy or not moving as fast, that's when we can make money in these non-directional strategies. So the IC1 is a non-directional strategy. We want the index to stay within a range. Overall, it's best to diversify, select 2 to 3 strategies and hold them for 12 to 18 months. It's almost impossible to time getting into the right strategy at the right time. So we all have the same challenge at the beginning of the year is where do I put my money? And it's always best just to select 2 or 3 strategies and then hold them throughout, at least for the year. Okay, let me just see if there's any questions coming in. All right, so far no questions. That's fine, and I'll just answer questions mostly at the end. But all right, Iron Condor. Just as a review, I'm going to spend not too much time on this. This is the index over here. This is like the rut, for example, and it closed on, now this is a very old chart. This goes back to 2007. So at the end of 2007, it closed at 830. And this chart shows the risk-reward graph of the Iron Condor, where we sell a call here, represents there, at this point of 890. And that's what we did right here. We sold the July 07 890 call. It's a 55-day option. And that's the product that we sell. People want to buy that call. Speculators want to buy that call because they're bullish. They believe that the RUT index is going to go higher over the next month or two. So they want to buy the call. So we open our storefront, we sell them a call. We'll sell them the 55-day duration, July 07 890 call, and that was that right there. And then we'll sell the bearish speculators who want to buy puts because they think the RUT's going to go lower. We'll sell them a 55-day put right here, and that represents the 760 put. Now we'll actually protect ourselves by buying a call, and we'll protect ourselves by buying a put. So this is a spread. We sell a call here, we buy a put here, I'm sorry, we sell a call here, and that's our product that we're selling to the speculator, and then we buy a call to protect ourselves, and that creates a bear call spread. Same thing down here for the put, we'll sell a put, that's our main product that we sell to the bear speculators, and then for every trade we open, we'll buy a put to protect ourselves. We create a bear put spread, I'm sorry, a bull put spread. So we connect the two together, it creates an iron condor. That's a bear call spread, a bull put spread, creates an iron condor. Okay, you might want to note this URL right here, and you can get to this picture and this picture. And I have more descriptions of the risk reward chart. And this is a bear call spread on top. I just show building one, and then when you connect to the bull put on the bottom, then you create the iron condor. Okay, so the URL is monthlycasterinterruptions.com/risk-reward-graph.htm. Okay. Okay, the key to making positive annual returns with iron condors and credit spreads. As I mentioned, 4 to 5 months out of the year, the market historically trends pretty strongly. And that is really difficult on credit spreads and iron condors. So we're not going to make much money or no money, or we'll have some small losses for those 4 or 5 months out of the year. And that's really only for the experienced people who really know how to move with the market. And it's not easy to do. It's really counterintuitive. You're trying to stay ahead of the market by 1 to 2 weeks at a time, and you're really moving on the days that you feel like you shouldn't be moving. So it does take a lot of experience to stay up with the market and stay a week ahead of the market. So during trending markets, we put on our adjustment hat. And the primary objective is move with the market, slide all our trades up. For example, after Trump won, that was one of the strongest uptrends I have seen in a long time. And it was just non-stop adjustments, moving and moving and moving and sliding up all the trades and trying to pay for all the adjustments. And if you can pay for every single adjustment, you can keep the losses really tight, -1, -2, -3 a month. So we keep our losses tight, trying to keep them between -1 and 3. Even if it's a -4, that's okay. I can make that back very quickly. I just have to keep the losses tight. And the key here is understanding and feeling comfortable that we're not going to make a dime during those adjustment periods. I know that, and I'm like, okay, and I might have collected a lot of premium that month, and all of a sudden the market starts moving. I have to keep up with the market. So I say, all right, I have to give it all back. I'm not going to make a dime now. Here I was up 10% for the month, and now I gave it all back, and now I might have a small loss, but that's okay. Goal is to keep the cash balances of the accounts relatively flat during an adjustment. That's the hardest part. It takes a lot of experience, and I think there are very, very few people that can do this consistently. During the 7 to 8 months out of the year, this is when we make our money, and that's it. So those 7 to 8 months out of the year is when we make our money. Okay, so let's look at the SPX. This is the S&P 500 index. 2016, 17, here's the 200-day line, that's the SMA. Here's the 100-day EMA. Right now, this last little pullback found support on the 100-day EMA. Here's the 50-day. EMA is exponential moving average. I showed the 13-day EMA, and that's just one faster moving EMA that I watch, moving average. And right now, we're pulling back. And what I care about is, will this lower level hold as support? That's what I care about. And will this higher level hold as resistance? And if it does, I will keep on trading these levels until it stops working. If this could go, this might go sideways for 2, 3, 4, 5 months. And if it does, I will do very well. I can make a killing at that. I'm selling my puts down here, and I'm selling my calls up here, and opening them up constantly, two-week in duration trades. And also what's nice is that this market is finally kind of running out of juice. I mean, we're sitting at 17.5 times earnings. Up here, we're at 18 times forward earnings for the S&P 500 companies. That's not a max. In 1999, early 2000, we ended up at 21 times earnings. So we know that the price earnings ratio can go higher, and it will. But right now, I just take everything month by month, or at least even week by week by week. And right now that, this market has come such a long way that we're probably stuck in this trading range for a while. And Trump, with his daily antics, is not helping much. So that will probably keep this more choppy and sideways until Congress gets back to work in the next month. Here's volatility. Volatility has popped up. This is the VIX, forward 30-day volatility, implied volatility for the S&P. Just tells me that, we're typically going through, this is August and September, pretty typical. Market's going to pull back, get a little more choppy sideways, volatility is going to pop up, and that's actually really, really good for non-directional strategies. Okay, let me just talk about what I watch. And this is really, all of this is in the advisory. It comes out every week. And you can just email me at brad@monthlycashthroughoptions.com or support@monthlycashthroughoptions.com, and I can send you a couple of the advisories. You can see what we cover. So it has a lot of charts, 50 to 80 charts every week. And I need to keep my finger on the pulse of the market and the U.S. economy and the European economy and the China economy and stuff like that. Okay, we have technicals. We'll talk about that. Price-based indicator, support, resistance, moving averages, volume, market breadth, macroeconomic data. I'll show you what we look at. One of the main things I care about is corporate revenue and earnings. Are they growing? Is it growing or shrinking? And right now it's growing, finally. Sentiment, other forces, the strength of the dollar, health of Europe, health of Asia, commodities, health of commodities, and high yield bonds. Okay, so again, I show all of this in the advisory. I literally just plucked a lot of this right out of the last advisory. This is the weekly chart of the NASDAQ composite. I watch the 17-week EMA, 43-week EMA, and as long as the 17 weeks stays above the 43, it tells me we're still in a long-term confirmed uptrend. And we're not done going up, but it's just the upside potential is dropping off quite a bit. Again, we'll get up to 2,500, 2,550 by the end of the year. That's my prediction. Probably up to 2,650, 2,680 by the end of Q1. But the risk of heavier down days is much higher now. So we have to be more careful on the downside risk. We watch the different industries, sectors. I watch about 80 different sectors because I also do a sector rotation strategy that we'll be launching as a service sometime in the next couple of months. But really just 15 or 20 sectors is all I care about for this service. I care about what XLI, the industrials, look like, and you can see it's rolling over. 13 is crossing the 50. It's finding support here so far. Just tells me that this market's more choppy and sideways now. Technology is still above this breakout, so it looks good. Technology is still looking pretty good. And this is the XLK that I use, and this is equal weight. So Apple and Amazon, they don't kind of tweak this whole index because of the CTF, because they would be highly overweighted if this were market cap weighted ETF. IYT, transports, and the minute you see transports doing this, that's kind of a sign that this market's going to get choppy. So transports is a leading indicator, and it's still, actually this chart is not quite up to date, so I think it's kind of still sitting right here, but it doesn't look that great. Banks, and banks really need to participate. We need financials and banks to be participating and looking good. Right now they're kind of rolling over because everyone's wondering now if the Fed is going to be raising rates fast enough, because banks make higher profits when the Fed raises rates. This just again tells me that we're going to be more sideways and choppy with the broad market. And XLY, consumer discretionary, things that we don't really need, like Harley-Davidson motorcycles or going out to restaurants, or pool tables like from Brunswick. I think all of those are like an XLY. And just tells me again that we're kind of running out of juice, kind of a double top here. But again, I'm not saying we're not going higher, because we probably are. We just have to get through the summer, and then the market will start kicking in again in September, October. And once Congress starts talking about raising the debt ceiling, and hopefully they can get through that and start talking about corporate tax cuts, then we'll probably start taking out higher highs. But I just don't see us climbing much more than 3, 4, or 5%. Market breadth, I watch, I don't know, about 50 different indicators, but I'm just showing a few here. NASDAQ, percent of stocks above the 50-day line for the NASDAQ composite. It's about 2,500 stocks, and you can see that only 34% of the stocks now are above the 50-day line. Usually if we're kind of in the 50% range or higher, then that's classified as healthy. So this has really pulled back pretty hard recently. But this could bounce fast also. This is really not a leading indicator. It's more of a lagging indicator. So you have to be careful on how you use this data. It's hard to time much of anything with this other than it just gives me an idea of more just duration of how long we're going to stay sideways and choppy. NASDAQ advanced decline line. You can get this off of stockcharts.com. You can get it for free or almost free. And this is a very good indicator. So it's the number of advancers minus the number of decliners on a daily basis. And then you just keep on cumulatively adding that number together. And this is the first time in a long time now since kind of the March, April timeframe where we pulled back this hard. So it just tells me that we got a little bit of damage to the market. We'll probably be sideways and choppy for a while, for the next 4 weeks, 6 weeks, maybe. Could be longer. NASDAQ McClellan oscillator. This is also based on advanced decline line, and when it's below zero, especially with this moving average, I show a 35 period moving average. It just tells me that we're going sideways to possibly lower, at least for the next week or two. This one usually looks out a couple weeks. Okay, monitor the charts for Europe and Asia. These other countries can influence our markets, so we have to monitor them. We have to make sure that China is okay, FXI, and it looks okay. Want to make sure that Europe is okay. I don't like this lower high here, but Europe in general is it's okay. And I know money's flowing over there. A lot of money managers are pushing money over to Europe, and here's Europe. Here are the top financial companies in the European Union. This looks strong. And for Germany, it's the largest economy, it looks okay. So wouldn't be surprised if we're going higher in Europe, and that's why money is moving over to Europe. And China looks okay. And also Japan looks fine. I don't show Japan here. Okay, for macroeconomic indicators, I watch the macro data every week. And payroll still looks good. We're still generating 150,000 jobs per month on average, and that's good. Retail sales recently came in pretty nice. So consumers are still spending, and that represents 2/3 of our economy. Consumer credit still looks good, and it's been very strong in the last 3-4 years. So this is really like revolving credit and non-revolving credit. It's mostly credit cards. So if consumers have more credit cards, they'll spend more and they'll drive more of the economy. So everything looks good for consumer credit. Seasonal trends. This represents, for example, in the last 100 years, 50 years, or 20 years. So for example, April, we can see that in the last 100 years, 50 years, and 20 years, the market has always been up in April. And yes, that is our strongest month. And now we're in August to September, and these are usually our weakest months. So we just have to get through these. For me, I like it because at least for the non-directional strategy that I run, it's perfect. So that's when I'm going to make all my money, and then I have to start getting a little more careful here in October, November, December. That's when the market starts climbing again. November, December, January, pauses a little bit in February, and then it just takes out new highs in March and April. So that's why I'm predicting the SPX will probably be at 2650 or a little higher at the end of April. Unemployment claims look good. So fewer companies have been firing people. Here's one of the leading economic indicators coming from the conference board. Everything looks good. ISM index. So just you'll see all this in my advisory, or let's see, briefing.com. I get most of these from briefing.com. That's a good website to learn about all this macro data. Corporate earnings, revenue growth. We're finally growing. We had 5 quarters of non-growth for earnings, and that was a big problem. The stock market started whipsawing. It looked like Hillary Clinton was going to get in and going to win. This market was basically telling me, being a chart reader, that we're going into recession within 1 year, and that was about 6 months before the presidential election, because earnings were not growing and the market was not happy, and it was just whipsawing and whipsawing. So finally, it did take off, and then it went straight up with the Trump win. But earnings are growing, and that has nothing to do with politics. It just has to do with companies getting lean and mean, and they were cutting back and figuring out how to make earnings in a low growth environment, and we're still in a low growth environment. We're at 2% GDP growth, and we'll see if it changes, but for a long time we've been at 2% GDP. Okay, high yield bonds. These are the bonds that companies issue, tend to be higher yield, and this can definitely impact our market. So I always watch this to make sure that it looks relatively healthy. It does. I don't like how it pulled back like this, but it's still over the 200-day line, so I think we're okay. But if this were tanking, then I would be very careful in writing puts, because we're most likely going lower within the next 30 to 60 days. So I have to be careful with HYG, with high yield bonds, strength of the dollar. This will usually push up the big caps. If the dollar weakens, our products overseas are cheaper. So the big cap companies who usually sell a lot of their products overseas do really well. This is okay because it's finding support, but the dollar has weakened a lot. And this is from mostly, in my opinion, and from the talking heads' opinion, it's from the Trump administration losing credibility, that they're going to be able to push through their pro-growth initiatives. And then bonds started climbing. We can see that people have been getting back into bonds. This is the 7 to 10 year, represents mostly the 10-year note. I don't really time to this. It just gives me it allows me to come to my convictions of what this market is going to do for the next 30 days. And that's what I care about for the IC1 strategy. Okay, so back to the SPX. So what are my convictions now? What are our convictions of what this market's going to do from where it is today? Well, after looking at all that data and watching how the market behaves from day to day to day and where it closes, how it closes in that last 30 minutes of trade each day, my prediction for the next 30 days is that high probability the SPX will hold above 2,400, could stay above 2,420, above this 100-day line, but it could easily retest 2,400. This is not a pretty. This looks pretty bearish. So, especially going through the summer months, and we could be a tweet away from Trump saying something, and all of a sudden the market will just retest 2,400. So, but my guess is my prediction is it will find support there, and I have a lot of exposure right at this level with my puts. If we break 2,400, different ball game. And then now for my strategy, I'm not making a dime. I'm sliding everything down because we're coming down to the 200-day line. Right around 23, 40, 50. That would be the next target down. I don't think that's going to happen. The economy is doing great and doing pretty well, and earnings are growing, revenue is growing. I just don't see. I see buyers stepping in pretty rapidly down at these levels. All right, and then high probability SPX will hit resistance at 2490 through September. So through August and September, those are usually seasonally weak months. So this is when I'm just making lots of bets up here, selling calls in the 2485 to 95 range, and selling lots of puts at the 2410 down to 2395. Okay. All right. So now with regards to back to the IC1 and what's different, it's a lot of trades, and you'll see. So you can go to the website. This is just a screenshot of the trades. Let's see, these are July trades. These are all Julys, and this is a screenshot of all the Junes, and I show all of the trades for 2016, and you'll see that it's just a very fast-moving strategy now. I'm constantly moving trades. Just about everything is closed out early, and I'm flipping trades. For example, right here I have a 24.65.75 call spread, and the market, evidently there was a major level there I was betting against, and the market broke up through that level, so immediately I flipped it and turned it into a put spread. So I flipped it into the July 26, 24.45.35 put spread. So here it is right here. So that 24.65.75 bear call flipped into a 24.45.35 put spread. I did it for 75 cents, and then I completed the iron condor and I paid for the flip. So you'll see I'll flip things a lot, or I'll roll them down or roll them up. If, for example, once we get up to 2,500, that is a huge level. One of these days, we're going to be at, the SPX is going to be banging up against 2490 again, 2495, 2500, and it's going to be pounding away at that level. And once we break 2500, we're going to be up to 2530 within days. And so that's a really tough transition point where I'm not going to make any money. The minute that we start touching that level, then I'm going to be flipping some of my call spreads into puts because I know we're going higher. Now it could fail, and I might have to flip them right back to call spreads, but I'll take that call spread at 2,500, 2,510, and I'll turn that into a put spread and drop it to, put it to the bottom. Because this market is breaking up through 2,500, and then we have, and half of this market these days is driven by algorithmic trading robots. And the minute that the bots see that the SPX just broke above 2,500 and held above 2,500 for 2 or 3 days, we're off to the races for the next week or two. And so I don't want to just be rolling and rolling and keep on pushing up the calls. I would rather just flip them to puts and overexpose on the put side, and then let the market climb up to 2520, 2550, something like that. So those months I'm not making money. So I'll give all my gains back for that month, and I'll probably suck down. I'll probably end up with a loss of a 2, 3, 4% loss, especially when we're going through a major transition point like that. And that's okay. I mean, that's just part of the business. And once I get through that transition of breaking up to 2,500, then I'll probably have 3 or 4 good months. And my bigger months so far are bigger. I used to shoot, I thought I could only really make 4, 5, 6% a month, 7% a month. But with this new strategy, the gains feel like I can get larger more easily. But we'll see. I don't artificially push anything. I just kind of go with my trading rules. I follow my rules very carefully and closely. I don't let emotion get in the way. It's a very mechanical process, and if the gains are coming in much higher, then so be it. And then I'll adjust accordingly. But at least my old strategy, my normal run rate was kind of 7% gains, 8% gains on the good months, and now, heck, I just had a 21% gain, and I'm sitting at a 15, 16% gain for August. But again, it's not over until it's over, and all of a sudden this market starts moving really hard in the next day or 2 or 3, then I'm moving. Then I'll have to give all that back. But we'll see. I have a week and a half left for August, 2 weeks left. Okay, so I think I'm done. It's just hard, just for the in general rules, when something is going up and I got a call spread, I'll roll it up, I'll push it up a week, I'll push it out a week, and I'll push it up 10 points. And then I'll slide up the puts to pay for the adjustment. So that's just a typical roll. So if, for example, I got this 2470.80 bear call spread and the market starts climbing into that 2470.80, I don't let it get too close. And usually I'll roll it when I'm 4, 5, 6 days out. That's another difference. I'm not letting them get close. I'm usually a week out. So I'll push that up. I'll push it up 10 points, push it out a week, and then I'll put a put on it to pay for the adjustment. And then in the opposite, if I have a put spread, like a 2410, 2400, and the SPX starts coming down into it, and if I'm 5, 6 days away, I will move it proactively. See, that's the key. I'm moving it much sooner, like a week in advance, and so I can do it cheaper. So I'll move that down to a 2400, 2390, and then I'll put a call spread on top of it. I will only do that for the puts if I feel the economy is still expanding. Okay, if I start seeing things that are telling me that this economy is starting to sputter, and we could possibly be going into a recession in the next year or 9 months, and I watch a lot of data, then I am very careful on the puts. I'm not just a technical trader. I was 10 years ago, but not anymore. I mean, ever since 2008, the advisory went from just a handful of charts being a technical trader up to an advisory that has 80 charts in it, that has a lot of everything in it now, because we do not want to be getting caught with puts if this economy starts to deteriorate. But at least for the next year, I don't see any problems with this economy, so we can just kind of move forward as usual with our with our credit spreads, and these are all 85% spreads, and pretty much on both sides, calls and puts. Okay, I think that is it. Here's disclosure. Please read that when you have the chance. And then thank you. And then here's our website. This is a good email to use, support@monthlycastinterruptions.com or brad@monthlycastinterruptions.com. Here's our toll-free number. All of our services have free trials or $5 trials, so you can try things for pretty cheap. Okay. All right, let's go through some questions. Okay. Okay, let's see. Please review how to determine units, dollars, and IC1. Well, this must be for auto trade. For setting up auto trade, we open up 5 trades at any one time. We hold 5 trades, and a trade could be defined as an iron condor or a credit spread, but I'll just say iron condor. So 5 iron condors are open at any one time, and each iron condor we open takes $1,000 of maintenance. The broker holds $1,000, allowing us to open up a 10 wide iron condor. So for example, that's a right now the SPX is at 2450, and let's say I open up the 2480, 2490 bear call spread. 2480, 2490 call spread. So I sell the 2480 call, I buy the 2490 call. It's called a call spread or a bear call spread, 10 points wide. Broker holds $1,000 of maintenance to hold that trade. Okay, so that's why we say all trades take $1,000 of maintenance. Now, by the way, on that 2480-90 call spread, if I open up a put spread and attach to that call spread, let's say I open up the 2400-2390 call spread. That's an iron condor now, but you can only be wrong on one side. So the broker doesn't hold $2,000; they just hold the original $1,000 for the iron condor. Okay, so an iron condor holds $1,000, and I'll hold 5 trades at any one time. So you need at least $5,000 in the account to hold 5 trades, and then you want some reserve cash. Okay, so now the way you would set your auto trade rule, oh, well, let me back up. So for reserve cash, you need another 20% on top of that. So you need $6,500 in the account, and so that would be the minimum for this service. So $5,000 you're trading, that holds 5 positions, and an extra $1,500 of reserve, $6,500 in the account, and you would set your auto trade rule to dollar amount and $1,000. So what you're telling the broker, now you do this through your brokerage account. Let's say you're at TD Ameritrade. You just log into your brokerage account and you go to the auto trade area, you select monthly cash-through options, you select the iron condor and credit spread, I think that's what they call it in there. You would select dollar amount and $1,000 for this example. So what you're telling the broker is every time we set in a trade, the broker's going to allocate $1,000 in your account to that trade. Okay. Now let's click it up one. Let's say you go up to $2,000. So you want to keep this in increments of $1,000. So the next level up would be $2,000. So you go into your brokerage account, you select the IC1 service, you select dollar amount and 2,000, 2000, you hit OK. You're done. What you told the broker now is every time we send in a trade, $2,000 will be allocated to each trade. Okay, so again, we're trading 5. We have 5 positions open at any one time. You're allocating $2,000. So 5 positions times 2,000 is 10K. So you're trading 10K, and then you want some reserves in there, maybe another $2,500 of reserves, so $12,500 in the account. Okay, and then one last example. Let's say you pop it up to $3,000 per trade. So 5 trades at any one time. 5 times 3 is 15. You're trading 15K. So you need to have at least 15K in the account plus 20% reserve. So you need about, let's say, 19 in the account. Okay. All right. Hopefully I answered that question. Was the best broker for a $150,000 account. All the brokers are pretty good these days. They all charge about the same price. E-option will advertise that they charge 15 or 20 cents a contract, but the problem is that for the SPX, I trade the SPX primarily, and the Chicago Boards of Option CBOE, they charge a 50-cent charge to place that trade. So E-option just passes it through. So even though E-option says they charge 20 cents a contract, they'll pass through that 50-cent charge from the CBOE. So here you're back up to 65, 70 cents a contract. So everyone's about the same these days. TD is good, TD Ameritrade is good, E-option is fine, Trading Block is fine, Auto Shares, interactive brokers, but you have to use a middleman for interactive brokers. So that's you have to use Global Auto Trading, and so you'll be working with two organizations instead of one, because interactive brokers does not auto trade directly. So Global Auto Trading is a separate company, and they charge $70 a month. So it's not recommended to use IB with Global unless we have most of our foreign customers who cannot open a US account easily. They'll go down the path of interactive brokers. But all these guys are fine. I've been auto trading through them for years, and they get the job done, and all the fills are about the same. So any of these brokers are fine. If you want more information, or you just want to talk to me, you can always just email me, brad@monthlycashthroughoptions.com, and we can always have a phone call. You can, when you call the main number on the website, the 877 number, I just have that come directly to my phone, because a lot of customers just have technical questions, and I can answer all of them. So and I usually pick up. If I don't pick up, just leave a voicemail and I get back to you. Okay, let's see. Can you show how much you allocate? 1 second. All right. Okay, can you show how much allocate to single trade from the account? Well, for IC1, we allocate 20%. So 5 trades are open at any one time, 20% to each trade. That represents 100% of the cash. Also, I've been doing much better of keeping the cash fully allocated. For many years, I was always underallocated. I was at 80%, I was at 60%. I was just always, I really had a hard time getting it up to 100%. And now, since I adjust so frequently and know that I can adjust so frequently and so much more nimbly, I'm keeping it at 100%. A lot, pretty much all the time. And I have my own accounts, and I've just been doing really well in them. I just keep them at 100% allocation. As long as I know the economy is not going into a recession, and I can usually, I look at a lot of data, and I don't see any recession coming for at least the next 6 months to a year. And I wouldn't be surprised if this economy grows for another 2 or 3 years. I mean, we'll see. But let's just take it in 6-month increments, no problems with the economy, meaning I feel comfortable with puts, meaning I can be fully allocated. And so, so IC1 again, it's 20% allocation to each trade. Let's see, what is the best broker? Then why use this strategy? I'm not exactly sure. Oh, when the marketing is trending. Well, okay, so why use this strategy when the market is trending? Well, I mean, sure. I mean, if the market is going straight up, heck, you could just put all your money into an index. As long as you're a chart reader, as long as you know how to read charts, you know how to read moving averages, you know how to read market breadth indicators like the stuff that I showed, and if you believe that the market is still going to be trending higher, then stay long. But now everything is risk reward. How much higher are we going versus a risk to the downside? And we're already at almost 18 times earnings. So that's the S&P are going to throw off $140 worth of earnings. That's where we are. So you multiply that by an 18 multiple. Actually, right now we're at a 17.5 multiple. It just tells you that the market's no longer cheap. So so the market's come a long way. I mean, it just went straight up after the Trump win, and it got expensive. It went up to 18 times earnings. So now we're at that point now. We're going to squeak out another 3 to 5% gains, but that's not a lot. I can make 3 to 5% in 2 weeks. And last month I made 21%, and right now I'm sitting at 15%. So During the times that I'm allowed to make money in this strategy, which is about 7 months out of the year, I can make really good gains. So you have to ask yourself, do I want to put all my money into the SPY, that's the S&P 500 index, ETF, the SPY, or the Qs? Do you want to put all your money into that and risk that 10% downside risk to make 5% to the upside? So the risk-reward characteristics have been deteriorating for the last couple of months, 3-4 months, and that's what we watch, is the risk-reward characteristics. And so the risk is a pretty nice, nasty sell-off, 10% down, and I can get through that. I mean, I'm not going to make a dime for 2 months. I won't. I'll probably have a -2, and then I'll have a -4, or maybe a -3 and a -5. That's still fine, as I'm trying to navigate through a 10% sell-off. But however, it'll probably bounce back pretty fast. It'll probably be a V-bottom because this economy is still doing pretty well. So I'll get through it. I'll have 2 losing months, and people who over allocate long in the Qs or the SPY or their favorite stocks or Facebook or the FANG stocks, just the upside. You just have to know how to read charts and know when to get out. That's all. Okay, let's see. I noticed that you often close early to free up cash next trade. I notice you often close early to free up cash for the next trade. If inclined to put in a closing order, what do you believe? Sweet spot close spread. Okay, for auto trade, unfortunately, you don't have any control. I guess so. Some customers don't want to close things early for 10 or 15 or 20 cents or 5 cents. They don't want to pay the commissions, and I understand that. And I have some customers that have been self-managed for a long time because they have enough cash in the account and they want to hold the trades all the way through expiration. And that's fine, as long as that trade looks rock solid and that it's going to expire out of the money. Then yes, you can hold it. I'll circulate these trades quite a bit. I'll get out the day of, a day early, 2 days early, 3 days early. If I can get out for 15 cents, I'll get out a week early, and so I can put that money back to work, because I can pay 15 cents to get out and I can bring in another $1 to open up a new trade. So I'd rather pay the 15, 20 cents so I can open up $1 and just keep on rotating that money at a much faster rate. And I think that's why I'm getting much higher returns, because I'm circulating the money quite rapidly. What percent of the credit do you try to get before closing early? It's usually 80%, 85%. I usually look at it more of, am I paying 20 cents, 15 cents, 10 cents to buy it back? I'm usually bringing in $1, 90 cents. So I'm booking most of the gain. I'm booking a good 80, 85% of the gain. All right. Let's see, a few of these are a little long. I might have to do these later. How far away from the spread are you to close it out? So I need, let's say that I'm at a 2490, 2500 call spread, and right now let's say the SPX is at 2475, let's say, and then the SPX starts climbing. Let's see, I want to make sure that I want a good 10-point buffer, and I want time on it, and if I believe that I'm getting close and that thing could get hit, I would prefer if I'm 5 points away, 7 points away, especially on puts. Puts is a better example because things grind up. They don't usually spike up, but when things fall, they fall fast. And so recently, for example, the charts are rather bearish. I don't like the chart of the SPX, and we need to be over the 50 and stay over the 50-day line for 2, 3, 4 days before I start feeling comfortable with the SPX. And we could easily go down to 2420, down to 2400, retest 2400. So yesterday was an up day, and I took advantage of that up day, and I literally did all day worth of trades. I took all my puts and I moved them out an extra week and moved them down another 10 points. I need them down farther. I want them closer to 2410, 2420. But so yesterday was a really strong up day, and it was cheap for me to move all my puts down farther and push them down and push them out, and then and then I'll complete the iron condor in the next day or two by opening up the calls to pay for that adjustment. And the adjustment was cheap. So I want more buffer. I don't want them to get too close. I want them to be a good, 10 points away. And if it feels like that at any time I could be down 15, 20 points based on the bearishness of the charts, then I will stay a week ahead and just keep on rolling them down or rolling them out until I finally see this market stabilize. Because I just don't, because the minute that it comes down and hits and I'm only 2, 3, 4 days out and it starts getting way too close, now it's going to cost me $1.50 to roll it, $2 to roll it. I don't want to pay that. So I move pretty fast. Let's see, did you backtest 2014 with your retooled version? No, and it's impossible to backtest this strategy. I know a lot about algorithmic trading and building automated systems. I have a guy in Italy who's been doing this for years, and so we'll be launching some automated strategies shortly. So they're all algorithmic, and this is impossible to at least run in an automated fashion. I would have to do it all manually, and that would take me days and days and days and days. But so I have not back tested. Let's see, why have IRAs been disabled for auto trade? Well, it's been disabled at TD Ameritrade. So TD Ameritrade is getting big. They have a lot of lawyers now working at the company. And when you get big and you have lots of lawyers and you have the ear of the CEO, the lawyers are very conservative. And so when the new regulations came out that I guess they're still coming out from the Labor Department, the lawyers were pushing hard on the CEO saying, hey, you shouldn't auto trade. So TD turned off auto trading on IRA accounts, and they're the only broker that has done that. All the other brokers are kind of ignoring it and just moving forward. Let's see, on a $200,000 account, what size do you use for each trade? I've been using 10 call spread, 10 put spreads per trade. Well, for our strategy, let's see, so yeah, so for a $200,000 account, if you were to set your auto trade rule to $40,000, then you would use up, if you set it to 40K, every time we send in a trade, 40,000 or 40 spreads are being opened, and then we would have a maximum of 5 trades at any one time, so that's 200K. If you have 200K in the account, you want to make sure that you're opening less than that because you want to make sure you have reserve cash. So you probably want to open, 30 at a time, for example, to make sure you have enough reserve cash in there. Just make sure that the reserve cash is 20% of the dollar amount you're trading. Okay. Can you auto trade a Canadian account? Because I don't think they will allow selling puts to auto trade any Canadian accounts. Yeah, the answer is no. That they have regulation that does not allow auto trading in any Canadian accounts, and I don't know why, but that's just the way it's been for many, many years, unfortunately. So we do have Canadian customers, but they're all self-managed. Let's see, for auto trade accounts, do you suggest or require that only activity is the trades? For auto trade accounts, do you suggest or require that only activity is the trades through the service, or can we put additional securities in that same account? You can put additional securities in that account. Just don't do SPX type trades. We have many customers I have a customer that has a $500,000 account, and they'll turn on like a couple of our services. They'll say, all right, I'll run DAC1. That's Pranav Singh's service. That's the directional one on stocks. They'll set up an allocation for Pranav's service for 100,000. He has a 100,000 allocation for the IC1 service. So it's basically 2 auto trade rules in the same account, and then they do their own stuff with the remaining 300K. You just don't want to be mixing in options, too many options, especially options on SPX. I would not do that because I'm focused on SPX. Pranav's DAC1 service, he's opening up calls and puts on lots of different stocks. You probably won't interfere with him anyway. His stuff is pretty short term and quick. But yeah, you can mix it all together in one account. The market would Okay, I'm just trying to read a few more. Now it's already 3:05. It looks like everyone's hanging in here, so I'll just keep on going. Okay, so brokers other than TD will auto trade an IRA. Any discussion with Tastyworks? Yeah, you know what? That's been on my list. I will take an action item. I need to get in touch with Tastyworks and get going with them. So I will make sure I call them. Thank you for the reminder. So that's Tasty Trades. That's the guy who started TD Ameritrade, I believe, and or Thinkorswim, and he's running Tastyworks, I guess, and Tasty Trades, and Tastyworks is the broker that they have now. Okay. Okay, let's see. As I understand, you said you would want to keep the losses between 3 and 4%, but your results chart shows losses much higher, somewhere around 35%. Well, that one goes back to 2008. So that was when I was trading. Everything was piled into week threes, or really monthlies. I was using monthlies, and I had puts that went in the money, and I had to roll those for a while to get out of them. And we did get out of those in the money trades. But it took a while, and I was a lot less experienced in 2008. That was the first time I ever experienced anything like 2008, the crash in October, November. And, you know, in general, I feel not bad about it. I would have done much better if I would have had much more analysis behind me. So back then I was a technical trader. My advisory was very short. It was just technicals. Here are the charts. Here are the trades we're making. And technical traders do fine until they don't, and then they get their face ripped off, you know, from, you know, like an impending recession, and all of a sudden the whole market crashes and takes out new lows, and that's what happened, you know, in 2008 in October. So I really wasn't watching a lot of economic data. I wasn't watching any economic data back in 2007, 2006. So after 2008, I came to the conclusion that this advisory needs to be a lot longer, and I need to have a blend of economic data along with technical data. So if I would have been doing that and having much more visibility into this economy that was really deteriorating starting in 2006, I would have had less exposure, but I still would have had exposure. So my loss, you know, it probably would have been less, but I'm not sure how much less. Maybe I would have had a 25% loss or a 20% loss. I still would have had a loss, no doubt about it, with that type of crash, but it would have been less severe, because our job is to allocate properly and not overexpose ourselves if we start seeing deterioration in certain things. And at that time, I really wasn't. I just wasn't seeing the deterioration because I wasn't watching it on the economic side. I do now. And because the advisory ever since 2008 is very robust, I watch all the data and have become pretty good with all the macro data, all the economic data. And again, that loss would have been smaller back then. Now, what I'm doing in the last 2 years is much more nimble, much faster moving. So will I still have a loss? Yes. When you have a big crash like that, and all of a sudden Lehman Brothers or someone, you know, closes shop, and we're down, you know, 500 on the Dow, and down, you know, 4 or 5% on the SPX over 2-3 straight days, I'll have 3 straight months of losses getting through that, probably. But I can probably pay for most of my adjustments, and I can probably keep those losses at -5, maybe a month, maybe -15 over 2 or 3 months. And in my book, that's perfectly fine. I mean, I got to keep those accounts, you know, that's you know, keeping the losses pretty tight for something major, and then I could make that back. You know, holding on to 75 to 80% or 85, or holding on to 85% of the trading capital would be probably pretty good in my book, you know, for something that major. Okay, let's see. Is time decay the calendar spread? No, calendar spreads, we turned it off. They weren't working. We had a calendar spread service. We started it pretty much right when Trump got elected. Market went up, volatility went down and stayed down, and we had this uptrend for 6 straight months. And calendar spreads just would not work. It's a very Greek math ratio-driven strategy. It's very math-driven, and the setups were nothing looked good. You just could not open calendar spreads, so it literally shut down the whole calendar spread strategy up until just about now. So we're kind of watching it, and Jaime Morales is the chief trader for calendar spreads, and he loves the strategy, and he's well trained in it. It takes a couple years to get trained in it, and he wants to do it, but it just was not working. So we just took it off the website, and he kept his losses tight. He kept them very tight. He didn't have any major blow-ups. He was keeping his losses at -2s, -3s, but he just was not making any money because the strategy was not working with that uptrend. That Trump uptrend was very strong. I haven't seen anything like that in a long time. Okay, so brokers, let's see. Also, I see dates. Okay, let's see. Recently, you have opened iron condors in one go rather than opening the puts and the calls individually. I thought you wanted to open calls on up days and puts on down days. Okay, so yeah, recently I have been opening some iron condors directly. I'll open up the calls and the puts. When volatility spikes up a little bit, I can get some reasonable premium on both sides. So as long as it's not too heavy of a down day, like today, for example, I opened up an iron condor. And let's see. Oh, actually, it's in a different service. It wasn't an IC1, and it was. I opened up a 24.85.95 call spread. I opened up a 23.95.85 put spread, and brought in $2.20, and that's huge. I mean, and so if I can get a $1.10, $1.05 for the call, even when we were down 4 points today, that's fine. I'll take it. I don't want to I'm not going to nickel and dime, and it's just easier for me just to give the broker the iron condor and an overall round price of like $2.10. And that's, I'll take it. So, on an up day, I might be able to get a $1.25 for that call. But also, this market is looking a little bearish. So if I can bring in the $1.10. These are only 2 weeks out. I look out 2 weeks and that's it. This is a 2 week in duration trade. I'll take it because I might end up losing the opportunity of opening that call because I do see some bearishness in the charts. Okay, are you using ETFs to get a handle on economic data? Yes, I watch all the ETFs. I watch about 80 sectors because we trade those sectors in the sector rotation analysis strategy. So, I'm watching copper, we watch silver, gold, the miners, watch commodities, watch, of course, where's money flowing? There's always money kind of flowing into different sectors, utilities, consumer staples, flowing out of industrials, flowing out of consumer discretionary. It does give you a kind of a viewpoint of what's going on with the overall economy. It does. So especially, copper. Now, copper really hasn't been a great indicator for the last 5 years because China can manipulate it, and China's just such a big economy using it. They kind of mangle the pricing on it. But regardless, yes, we do kind of watch all those sectors, and I watch sector rotation on a daily basis. I can see where the money's flowing in, where it's flowing out, and I can tell if the overall economy and overall markets hanging in there. That's all I care about. All right, let's see. For charts, I use Profit Source. They're an Australian company. So Profit Source for my charts. Stock charts I use for breadth analysis. I use the Thinkorswim platform also. So that's very good. I use that for charting and for all the options trading. Okay, I think I am out of time here. Oh, and I'm seeing people are starting to fall off. So why don't we stop there? If I did not get to your question, because I see several more that are here, just send them to Brad at Monthly Cash Through Options, and through is THRU, Brad at monthlycashthroughoptions.com, and we can continue to talk, okay? All right, well, thank you very much for joining, and I'll see you next time. Okay, thank you. Bye-bye.